This is a conversation with Deepak Nuli, the founder of Kresko. Kresko allows people to invest in equities or stocks using the synthetic assets. So the mission behind Kresko, what Deepak is very motivated to do, is help democratize or make free trading of equities and stocks on chain. Deepak talked about his story, frustrating experience in AMC and GameStop, and viewed the middleman as having too much power, and felt motivated to create Kresko to allow people anywhere in the world to trade these companies using this synthetic asset. So we talked about how he created the first version, where they are, they've raised money, how they raise money, how they're building the technology specifically. A fascinating concept, something I had really not been familiar with before, this idea of synthetic assets tied to real world pricing. So we talked about how all that works, and then we branched off into different conversations outside of crypto. I hope you enjoyed this conversation. Here is Deepak Nuli. All right. Just like that, Deepak, we're live. Excited to chat with you. You have a pretty exciting background, and you seem to be interested in many different things right now. Why don't we kick it off with you specifically? What are you working on? What were you working on before? Give me your quick overview of your interests and past couple of projects that you've been involved in.
All right, I think there's some problem with my internet, but
Sure.
I think you were asking about what projects I was involved in before this.
Yeah.
So before TradFi, my background has been mostly in cybersecurity. I did that for almost 15 years. And when I decided to start my own company, I decided to hey, why am I helping TradFi? I actually went and started doing cybersecurity for TradFi. But I've always been interested in crypto for almost more than 8-9 years now. And I was so disillusioned with that. I was okay, I'm going to just stop that. I focus fully on doing cybersecurity for Web3 companies. So through that, I got to meet the Celo blockchain people. Initially, we did validator audits for their validators. That was literally first of any proof of chain network. Proof of stake network, and I don't think anybody has done yet, in the space of doing security audits for the validators. And through that, I got involved more into Celo, helped build their first security team, and then since then I've been here at Kresko, and we can dig deep later of our story as well.
Well, I'm curious. You mentioned it's the first ever security audits for validators, or specifically for Celo?
Yeah, so I don't think so. This was the Celo Foundation officially decided to hey, as a part of joining the validator group, we want to make sure the validators are secure, and so we had a few checklists that we wanted the validators to do, and then we went and ran a script, and also saw their security setup to make sure that they were all secure. They were using hardware wallets and things like that.
And what if you were to just give me the description of what is the security advisor, security auditor? What do you think about the most? I mean, what's the 80-20 principle? Where do you first go when you think about either auditing a company or creating a security team? Conceptually?
Yeah, it depends from person to a company, and usually I think one of the best ways I think for security is user education. That is the biggest win is if usually it is the weakest link, right? You can bring in these firewalls, you can bring the most complicated EDR, MDR, whatever, these security tools. But if your users do the wrong thing, game over, right? So that is the biggest thing I think. And I used to also focus in my security days mostly around social engineering as well, a lot. So that was hey, how can I talk to people and then try to get them to reveal things that they wouldn't normally reveal, right? And that you can like get like pieces of information and build like a profile and then, compromise somebody. So I think I would say like, yeah, that is one of like the biggest things I would focus on. Apart from that, just, like trying to do security by yourself. Like, for example, there are tools, right? Like even like creating a password, right? Like you try to create like a lot of these like complicated passwords and you end up making mistakes or you end up using the same password over and over. That is another big win, is just use different passwords for different accounts. That will solve like 80%. Like as I said, like it's like just use a tool. Like, so one of my favorite tools is a open source password manager called Bitwarden. It has better user experience and design compared to even like the paid products like LastPass. So I'm a big, huge fan of LastPass. Of Bitwarden. And if you want to use that, like it has like this place where it says, okay, generate password for me. And you just generate password. It'll store it for you. You just have to remember the password to one thing, and then it's it. Like then you get unique password for everywhere.
It's Bitwarden, it's called?
Yep.
Bitwarden. So what about company-wise? When you were to say you jump into a company, they're like, just say they're doing, say traditional finance, they're maybe a 50-person, 100-person company, they've raised $10, $20 million, building some payment tool. Do you first go through and say, let's audit the customer journey experience, make sure you're teaching people correctly how to store, manage passwords and that kind of thing? Or do you jump in and say, let's tackle the company's management of passwords, encryption, other major technical vulnerabilities? Is there a playbook that you would think about generally?
Usually, like the way security works is people don't just say, oh, like tell us like what to do. It's usually they have like specific goal in mind. So usually if you are looking for, hey, like we want to increase the awareness of security for our users, there is something else we would do. But if you want to like look at their infrastructure and things like that, there is something else. In general, I think this is a general that'll apply for any company, is if you are looking for like making sure that employees are secure. I think nowadays that with so many like cloud-based applications that we use, your browser more than even like computer nowadays is like the biggest like surface area where somebody can like compromise you. So the best thing to do is making sure you remove all those like Chrome or whatever browser you're using. Just try to minimize the amount of like plugins that you use, because literally you're like voluntarily, when you add a plugin that's reading everything you do, so you're like in a sense like voluntarily adding like a backdoor into your computer through a browser, right? So just making sure that you keep the least amount of plugins in your browser as possible. Some cool like browser plugins you can use for like security reasons, right? Like, so I use something like called Web of Trust. So this is something that will help you be like, hey, you're navigating the web pages on the internet, right? There is no map. There is no, on the internet, nobody tells you, hey, this is like a safe place. This is not a safe place. So like these tools like Web of Trust is, when you install it, it tells you, hey, this website is good or bad. It'll just have like this like green icon in the top right corner, and it'll tell you, hey, if I'm visiting this site, is it good or bad? So that is, I would say, like a few easy wins. There are other like plugins also you can use, like Privacy Badger or uBlock Origin, to block all the ads. Literally, when I look at like YouTube now, I don't see literally any ads because I have like these like plugins. So these are like some small wins, no? Like you just have these things on the user level, and then of course, like there are other things, right? Like if you want to do your infrastructure security and stuff, there are like you go a little more like do complicated things.
Yeah. Interesting. Do you have a thought on browser specifically, whether you're on Chrome, Brave? I interviewed the CTO of Brave a while back, and I personally use it, but do you see that as being advantageous, one browser versus the other?
Yeah, I mean, they both share the same like engine, right? I think it's just then what kind of data are you collecting? Definitely, if you're worried about privacy, I would recommend using Brave. But Chrome makes it also like so easy. It is like what I like about Chrome, or even like Brave as well, allows you to do this, that Firefox does not do as good, is creating different profiles. This is something that I would actually recommend, is using different Chrome or Brave profiles for different kind of works you do. So that keeps like a separation of work, right? Nowadays, like we all do everything on the internet, we use browsers, so sometimes we end up using the same computer for work and for personal. So just keeping that separation of use, like keep creating a separate profile for your work and separate for your personal use. And even like I would say, either a separate profile if you're doing any crypto transaction, use a totally different profile, or use a totally different browser itself for that one. That way you're totally like, when you go to that browser, you're like, okay, like now I'm doing crypto, I'll not do anything else here. Then the chances of you like by mistake clicking on like some malicious link, and then that compromising your browser like history or like whatever, and then stealing something from that browser goes down, right? Like, because when you go to that dedicated browser, I don't even like, try to like Google search anything when I'm doing my crypto. I already have like the like legitimate like links to different like crypto projects and apps, and then I can just like click on those links, right? Then I'm not actually going from some other link. And I think a few also, like I would say, ways to secure yourself would be, hey, you say like, oh, what is the, I don't know, like URL for Curve again? And a lot of times what we do is we Google search and click on like the first link there. And one pro tip there is like never click on like advertisement links, because a lot of times hackers like compromise the AdWords, and then you can like get compromised that way. So once you have like these like ad blocking like plugins, I mentioned like uBlock Origin and Privacy Badger, ads don't even like show up. But if they show up, don't click on those. I would use a separate browser, try to find the URL. And good ways to do it would be somebody who has already vetted the URL. So instead of just Google searching, you can go to like DeFi Llama, or go to CoinMarketCap or CoinGecko, and try to use the links there, because they have like a security team, and they want to they usually like vet like what is a good link and not.
Interesting. That's some good tips for even for me. Thinking about the different browsers, thinking about minimizing plugin. I have way too many plugins, which is probably not a good thing. And then, yeah, man, good suggestions here. Bitwarren, and then the Web of Trust. You are a knowledge pool. Shifting gears a little bit. So then you started Kresko. Why did you start Kresko, and what did you sort of see that got you excited to build this, go in this particular direction?
Yeah, when I actually started Kresko, I was almost like about to create a security company, like to do like security audits for like other blockchain projects, and that was the direction I was going to. But what happened was the whole like GameStop issue happened last year, when these like Wall Street bets people started like started like buying the stock to, or like like these hedge funds were like shorting it. And I got really mad when like they started, like SEC started intervening. Robinhood said, "Oh no, you can't trade this anymore," and they even like forcefully like started liquidating people's like portfolio. I was like, "Oh my god, like this is so bad!" Like I didn't sign up for this, and then I went and bought like I don't even trade stocks anymore, to be honest. I went and bought GameStop just to like support these guys. I was like, okay, like I'll put like couple of grand here, even if it goes to zero, I don't care. I don't care about the money. I want to like, like to support, like be part of this like thing these kids are doing. And then through that, I was like so mad. I was like, okay, like I think I need to solve this now. And this is more important to me than doing the security thing I was doing. So I went and like started looking at like different synthetic asset protocols. And I was surprised actually. I've been doing DeFi since like, DeFi started, but had not delved as deep into how the protocols are designed. So I looked at like a few protocols, right? Like the main ones like Synthetics, Mirror. And I was like, okay, like these protocols are there. And everybody was telling me, if you want to build it, why don't you just like fork one of these and then you'll go to market sooner? I was like, okay, like these protocols are like pretty badly designed, and I don't want to like, it'll be super hard to like improve that design afterwards. So I've like in my career, right, I've broken a lot of like web 2 like protocols, and I was like, okay, I think I can like help design a better system. That's how we got started. Put our own, like I have a small, like I do like small angel investing, so I put like my own money into my project for a while, and then got that going, and then after some time, yeah, we went and like raised some money as well.
Interesting. So wait, when you earlier you mentioned the problem you wanted to solve regarding AMC and GameStop. How do you articulate the problem that existed that you felt inspired to solve?
The biggest thing was, of course, the censorship resistant around it, right? Hey,
Okay.
like we as people, like we create this value for ourselves with our hard work, like, and then like somebody comes and tells you, hey, you can't do this with your own money. That is not right, right? And then of course, then also other things that I also wanted to solve was bringing this kind of like access. When you look at it, this is like one of the biggest like values that we have at Kresko is, hey, we want to make things like accessible. And looking at even existing synthetic asset protocols, they're not very accessible to people. It's so complicated to use these protocols, and wanted to bring access to like the rest of the billion people, right? Like people in like Nigeria, people in like Philippines, who maybe have don't have as much money, they don't even have bank accounts. Sometimes, how can we bring access to like the wealth creation tools, right? Like stocks and commodities, especially the US stocks, have been growing so rapidly in the last like 10 years. While other like investment tools have not grown that much, right? And local stocks as well, not as much. So, but people are just like, don't even have access. So wanted to bring that access.
Yeah. Yeah, I completely agree with you. It is super frustrating when there are entities, companies, individuals, effectively human beings that can stop other people from trading. It just is, I mean, this is the kind of enthusiasm that inspires people in crypto to take action and build, because we can build a structure that allows for, and I think inherently my thesis on this is that the reason why you and I and many other people share this enthusiasm to allow free market to occur, that no centralized organization should be able to stop people from freely trading, is that this most genuinely represents the structure of nature. Like, show me in nature where there's some authoritarian that's like, okay, cheetahs, you hit your quota for those gazelles, like you're done. Like capitalism most fundamentally represents this nature of life, which is that things happen as they happen, like trades happen, people buy and sell goods, and that when you allow that to happen, there's a collective intelligence that's developed. It's like the collective intelligence in the case of AMC and GameStop was like, hey, we see what's happening on the hedge funds, and we want to come in and collectively aggregate this intelligence and disrupt that exploitive trade. And to stop that from happening is like to put animals in cages. It artificially contains the intelligence that can happen in a free market. That's my theory on it, and I think that's why like open and decentralized intelligence is so attractive and almost intuitively or innately just and exciting. Which
Yeah, I
I
agree,
think,
like
yeah,
100%, right? And also, I think what the amount of like rapid innovation we are able to do when things are open is mind-boggling, right? It's literally exponential. Like I don't know, like 2008, like these like a lot of these Lehman Brothers and these people like just imploded, no? But do we have their IP? Like, do we know what like mistakes they did? Of course, high level we know, but do we know what is their software, like how was it designed? Like we don't know, like nobody can go and improve on that, right? Of course, like in crypto as well, we keep losing this money and like all these bad models, but the system learns, like we become
yeah,
resilient as we go further and further, which is just like not there in Web 2. Even with like people are like, okay, we lost like $16 billion or whatever with the whole like Terra and Luna ecosystem. But dude, like everyone knows like what happened on chain. We can see economically what is bad. We can see the code what is bad, and now somebody else can try to do the same thing but improve on those things, right? We can keep experimenting. We can keep like learning. Like the feedback loop is immediate. Like it's not even like our protocol, right? Like we have already released a protocol on GitHub. Somebody else can be like, oh, these guys are slow. Like we'll go and like improve on these things. We don't like these things, these three things. We'll just take the code and like go, build it. Like, like it's cool.
Totally. I think it's a form of evolution. It's like here's the overall structure is that evolution, the theory of evolution, whether life is evolving or a method of cryptography is evolving, they're just abstractions. And the way that this works is you have to put something out there and get a reaction. Put something out there, get a reaction. And this process of like A/B testing or putting things out there, getting a reaction is how you develop the intelligence of how to build systems. And what I view as the healthy way to do it is to get a lot of little interactions. Like people get burned, they trade crypto, they lose a couple $1,000, they're angry, and then they learn, then they manage their keys better, then the protocol improves, or something happens to improve. In the case of Luna, it's a big thing, right? It's a big, like a lot of people lost money and it's a big learning, but ultimately the crypto industry is so big that the impact from that doesn't cripple the whole industry. It's like it ripples out and then makes everyone stronger. So you can't necessarily say it was a bad thing because you don't see how it improved the security of the whole system. And I feel like by analogy, your immune system in your body, in order for you to have a strong immune system, you need to constantly be exposed to pathogens, viruses, and bacteria. And by doing so, there's a lot of little battles that occur. You get stronger internally, you have a more complex system, and you can handle that when the big one comes in. And like if you lock yourself in a room and don't expose yourself to anybody or any pathogens, like as soon as you walk outside, it's going to be like World War III in your body. And I think that's the philosophical, like, it's like people somehow that's not grip. People aren't gripping that idea. And, it's like you pay for it somehow. So, yeah, I appreciate that. It's interesting. So, all right. So you are, where were we? That was so interesting. A little rabbit hole we went down. So, you're interested in AMC. You feel like that is a problem. I totally agree with you. Your solution to that is synthetic. Do you view it as synthetic equities trading to allow people to trade securities like on the NASDAQ stocks synthetically, meaning on chain, not for the real securities themselves, but on-chain representations? Is that the road that you went down, or did you then change directions, or how do you spend your time now?
Yeah, so I can explain like what it means to be a synthetic asset protocol. It's a little different than saying, oh, it's synthetic trading because it's on blockchain. It's not that. It is because it is creating a derivative, right? Like, so there's Tesla that trades on the stock market. Right? There are two ways we could bring that Tesla on chain. One is like USDC. I could buy like a bunch of Tesla and then put it in my like the company's name, and then make on-chain representations of that, and then be like, okay, like here, like now we can trade Tesla. Now we can. So that is more like a custodial solution, right? Which I'm not as keen or interested in. I consider myself like crypto native, like many people. And I'm like, okay, like the other way of doing this would be, what's it called? Like maybe something like collateralized, like stablecoin, right? Like maybe like, let's say DAI, the previous version, right? When you could create like wallets just with like ETH, no? So what we do is you over collateralize something. Instead of now generating like $1 worth of stablecoin, we generate any arbitrary token. So in this case, like a Tesla token, let's say I wanted to create like, I don't know, $100 worth of Tesla. So I give the protocol $200. So I've over collateralized my position, and then I can borrow that $100 worth of Tesla. And then now that is a synthetic Tesla, right? It's not like the real Tesla. Nobody has it in their like custody. it is artificially created, and then we use like an oracle to make sure that the price when we are creating is taken from that oracle from the current price of Tesla. So that makes it synthetic. So it is not, so as users who come and like then so once whoever is creating it, right, like they can borrow it. Let's say I borrowed $100 worth of Tesla, then I can add another $100 worth of, let's say, I don't know, USDC, and then create a pool on an AMM like Uniswap or Trisolaris. So then there is liquidity, and then somebody can come and buy and sell that Tesla token, right? What is missing there would be, right, you can get access to the price of Tesla, but it does not give you other rights. You won't get like dividends. You will not get any like voting rights and things like that. But at least that is better than having no access.
And in that case, sorry, who is actually owning the stock in terms of like SEC? Like, where is that? Would that be centralized? And then,
so yeah, there is no centralizing factor, right? It's like right now, like DAI, right? Like who is owning DAI? Like it's created by the protocol. Somebody has taken a loan, right? So the counterparty of that trade in terms of a DAI is you create a vault, right? Like the smart contract itself is the counterparty. It locks in your collateral and then it gives you DAI. In our case, similarly, it locks in the collateral. It could be ETH, it could be USDC. And then when you borrow that Tesla, so then it is backed by something, right? So they can always go and return that whatever Tesla you borrowed, right? And it gives you back your collateral.
Is this live?
We are not live yet. So we are going to be live in the coming like 1 to 2 months. So what we are doing now is we are enabling our like alpha. We're creating like a alpha waitlist, and then we'll launch like the alpha product on the Aurora testnet on Near. And then we want to like, like battle test it during this like alpha testnet phase with like, we want to bring in like, so this is like a call, like if you are into like DeFi and are interested more, like we would like to bring in people who have a little more like advanced knowledge of DeFi so that they can help in creating like market making, right? Like we want people to come borrow the product, synthetic assets, create markets. And also like we also have like liquidators on the protocol, right? Like somebody has to make sure that the assets that are being borrowed are always over collateralized, right? So to keep the protocol solvent. So there are like these actors called liquidators who can see, hey, like if something is under collateralized, they can go and like liquidate positions and they can earn like fees for doing that. So we want to test all these things out and make sure that the protocol is safe and sound. So what we're doing is we are creating like first, like just on the testnet, we're doing like an alpha release. And right now our like, what is it called? The waitlist has opened, and you can go to our website and sign up for the waitlist. And yeah, then we plan to actually like cut it down to like 50 people. We want like 50 active people on the testnet so that we get enough like feedback. So we will probably just gate it to like 50 people by actually just sending like a fun, like this Degen quiz, no? Like a lot of people do this, like, hey, what is your Degen score? So we're right now like building a quiz so that we want to make sure that people who will come and use it actually know what they're doing. That way we get good feedback.
Yeah, degen, short for degenerate, or people who are on crypto that just are fucking around. Essentially, is that how you think of it?
Yeah, so those would be degens. So what we have termed a new terminology called mission-oriented degens, right? So we want people who are on a mission, but in reality, like we don't want like sophisticated users, right? Like sometimes degens are just like aping into things, like I'm using a lot of like crypto words here, but instead of like people who don't know what they're doing and just ape in, we don't want them just yet. If they want to come and use the protocol, it will be open when we finally release. For right now, we're looking for more like sophisticated users who know what they're doing, like who know things like over collateralization, who know like what a collateral ratio is, and things like that. We want them to come and like sign up.
Yeah. Okay. Is this available anywhere else in the world today? Could I trade a equity on chain through a synthetic token or synthetic, what'd you call it? Protocol?
Asset. Yeah. So
Asset, yeah.
there are a few, right? Like, so some centralized exchanges do synthetic assets, but again, like it's like centralized, right? It's not interesting. There are two big protocols I can think of that currently exist. One is called Synthetics. It's on the Ethereum blockchain, and I think they moved on to Arbitrum as well. So they're on the L2 and there as well. They have a different model. And then the other big player here in this market was Mirror Protocol, which totally like imploded like in the recent weeks because it's part of the Terra ecosystem. Again, like there is something around like, you know, like security considerations that they didn't think of was this is more on the economic security side of things. They were using exclusively UST, the Terra token, like the US Terra token, as collateral on the protocol, and they were also using, I think, like other like Luna based tokens, like Luna, A Luna, B Luna kind of tokens. So now, like literally, like those assets were backing your synthetic assets. Now, if you make that wrong decision, right? Like if you don't have a good asset as your collateral, then if that collateral asset like implodes, then your protocol is done, right? I don't even know like what's going to happen with Mirror now. In the same sense, like I think Synthetics as well has only like one token that they use as collateral. It is the Synthetics governance token itself. I think that also has a big risk, no? Like if that particular token for some reason like starts crashing or something, then the whole protocol and all the assets being backed by that protocol will just implode.
Yeah, and in fact, what you're saying is that the collateral, meaning the value you have to put up to get the equity or the synthetic asset representing the equity, is that value, that collateral, is something that the protocol, Synthetics in this case, or Mirror that was relying on Luna, that's something that it has to work. You know, the collateral. If I put my house up for a collateral on a loan, and then my house burns down, well, now there's no collateral left. So the collateral has to be trustworthy. So my question to you, why wouldn't they use like Tether or DAI or USDC or some more trusted stablecoin for collateral?
Yeah, I think it's just bad design. One reason I can think of is, hey, like we want to create, sometimes it's like, oh, we want to create like demand for our own like ecosystem token, right? Like with UST, they wanted to make sure like they had enough like protocols within that ecosystem that will use that collateral. I can think of that as one reason why they said, oh, we just want to use these tokens, right, and not those other tokens. Same thing with Synthetics. Yeah, I think that is like a recipe for like disaster waiting to happen.
Yeah, and by contrast, the method of collateral you would use here for Kresko would be what again?
So we'll be using a basket of tokens, right? So we'll have, and again, like it's open, like we can also like have governance to add more tokens. So in the beginning, we're thinking of ETH, we're thinking of USDC, maybe the native token in the Near ecosystem, either like the Aurora token or the Near token. And maybe if there is DAI, we'll use DAI. So these are some options that we are thinking. And again, I think here, one thing to note is not every token is equal, and you have to also like value them separately, right? Like let's assume that even if I were giving like $1 worth of ETH to the protocol versus $1 of DAI, so those two should be valued differently, right? DAI is like a stable coin. So I would say like, okay, like $1 worth of DAI, the protocol can treat as like 99 cents, right? Like, because there is still like some risk there. In case of ETH, maybe ETH is more volatile, right? Then we say, okay, like the protocol will treat $1 worth of ETH as 80 cents. So then that way the protocol is like safeguarding itself and like asking people, hey, if you give this as collateral, then maybe we'll consider only less, then it will incentivize people to give different collateral that has like a higher like safety, right? So we have like these kind of like parameters that we add to keep the protocol secure. A lot of people do this, right? Even if you go to like Aave and you want to borrow, and if you give something like ETH as collateral versus give like something like DAI as collateral, so they have like this like loan to value ratio. So they consider the percentage different for each. Like I can borrow maybe, I don't know how much the numbers are, right? Like if I give $100 worth of DAI, maybe I can borrow like $40. But if I give ETH, maybe I can borrow only $30, right? So that is like the risk adjustment that a lot of protocols do. What they don't do is risk adjustment on what asset is being borrowed. So this is something that we are also innovating here is we can make our protocol much more like secure and resilient by also treating different assets that are being borrowed based on their risk, right? Like let's say I borrowed gold versus I borrowed Tesla, right? Tesla is more volatile, so it's more risky. So maybe I should pay more to borrow Tesla. If I want to borrow gold, I should pay less, right? So then we have like these like parameters on the protocol that will adjust risk. In general, like most of these like lending and borrowing protocols, synthetic asset protocols have something called as like over collateralization ratio. So what this means is it'll have one number, right? Like let's say if you want to borrow $100, you pay $150. So then you have that 150% as collateral. So you so that is a global number that applies to enter throughout the protocol, right? But if we want to also be resilient, what we want to do is we want to add these like security parameters for on the both on the collateral side and also on the asset being borrowed. What that helps is like, okay, like you have these global numbers. Otherwise, every time you want to add a new asset to the protocol, if you don't have this, then you got to change the global like collateral ratio of the protocol to keep it secure. So what we do is we make it more flexible by saying, okay, there'll be one global collateral ratio. Let's assume that it is 150%, that we want people to have at least a minimum of 150% over collateralization. But at the same time, when somebody wants to borrow some risky asset, so we have another parameter called KR factor. So we say, okay, like if you want to borrow $1 worth of Tesla, you have to pay us a premium like of 20% more than what you would pay to borrow gold. So then we're making the protocol more secure by creating these like risk parameters.
That makes sense. Would that be an open variable that would fluctuate based on market demands, or something that's more controlled by the protocol, I guess?
Yeah, so it's usually it will change, but it will not change like day to day. It may change every like 6 months or a year. And the way we do it is we look at the volatility. Like we look at the exponential like average of the asset and say, okay, how volatile is this asset? And then we decide like what the factor should be.
I would think that would be something that would just fluctuate as market demands go up and down, but that's not how you're thinking of it. It's like,
no, that's not how we're thinking. For the safety of the protocol, it's not about the market demand. It's more about how safe that asset itself is, like how volatile or not non-volatile it is.
I see.
Right?
The
If
risk
some
of
asset,
it, yeah.
let's say, yeah, if we say like, right, like maybe there is some like penny stock or something, right, which is going up 100% or 200% every other day, right? And then maybe it falls down 100%, then that has more risk than gold, right? Maybe gold is fluctuating between like 1 to 5%, right? So then we have to like add like a higher premium on people borrowing those risky assets.
Because you as the protocol need to be able to pay out when people come back, trading back whatever they borrowed, gold or Tesla stock.
Yeah, and that is one reason, and the other reason is to make sure that protocol always have enough, right? Like if there's a flash crash, right, and somebody had borrowed like $10 million and given like collateral, right? Like if the price just goes up so fast, and then even like if there's not enough collateral to back that anymore, then we become under collateralized. So by adding this like premium, it helps like stop some of those things from happening.
But technically speaking, is there always a risk of under collateralization of DeFi exchanges, DeFi markets here, like Aave and Compound, and like could they become under collateralized and not be able to return funds to people?
There's always that chance, no? Like we can never like So what Aave has is like, Aave is pretty cool actually. Like what they have is, if something goes under, like of course you over collateralize and people borrow, but lenders are at risk, right? Like if there's not enough collateral, if there's a price
Mm-hmm.
crash, so that's why you over collateralize, right? Like that's why you're giving like that
Mm-hmm.
150% or one whatever that number is. That is one way. And in our way, what they have is they have like I think a safety module where like like people who stake the Aave token and get rewards. So in that protocol, like up to 30% of that staked Aave tokens can get liquidated and be backed in case of these kind of events. So then the
Oh.
people who are more part of the Aave ecosystem, then they are getting these rewards, but they're also helping backstop in case of under collateralization. For Cresco, right? Like we will introduce something like this for Cresco as well. But right now, what we're doing is we're not releasing a token when we are launching this project. So we'll not have that in the early days. But once we have our token, we'll also think of something like similar to like a safety module that is like backers of like last resort.
Mm. Most people I talk to have a early emphasis to launch a token. They usually launch a token. They'll maybe write a white paper, maybe come out with some beta products, but then go and reach out to institutional crypto investors, get a few commitments, do a pre-sale of a token, and then get the rest of the retail investors to buy into the pre-sale of the token or launch a token and use that to capitalize the business. Is that playbook not what you're following, or how are you thinking about capitalization of like funding the business?
Yeah, so we are, of course, think it's a similar process, but what we are avoiding is like creating this like hype base, like, hey, let's create a token, let's hype this project. That is what we want to
Yeah.
avoid. We want to take our time and build a token that actually makes sense and bring it. Uh, yeah, we even like, of course, like what we did was the opposite. Like we built our protocol and we wrote our white paper now after finished building the protocol. And then like, like we didn't want to just like raise money on like a white paper, right? Like we built something, we can show things to the people. Yeah, of course we did raise like institutional like capital as well. And then now what we want to do is, yeah, like what we want to do is battle test the protocol. We want to see if we can create a protocol that works, without creating these artificial like incentives, right? I think creating incentives is a good model to bring adoption, but if we do it too much, it's not good for the protocol or the ecosystem, like we saw with like the whole like Terra and Luna ecosystem, right?
Yeah.
It just goes out of control. So what we want to do is we want to make sure that the protocol we're building is economically safe and sound, and then we also want to introduce like incentive mechanisms in a way that makes sense and actually incentivize actual people who are invested in the Cresco protocol, who want to support the protocol and give the tokens, try to get the tokens to them and not just to some like, we're talking earlier about Degens who just come and like want to do like
Yeah.
some farming, make their rewards and this leave, right? Then we're just giving up like this token that could be given to like actual supporters of the protocol. So we want to
Yeah.
think through that a little bit more before we launch it.
I like the way you did it, frankly. I think I'm always surprised that people find as much success as they do on writing the white paper, shooting the token out there, and then building the protocol, because things change. You don't know I mean, how many iterations you go through of figuring like, this is how I want to build it, but then it changes. I
Yeah.
think the white paper is like a published first idea. It's like, this is how it might work. And then you don't give yourself the flexibility. Granted, if you code it in, it's written in code, so it's slower to change, but you change a protocol over time.
Course, like we actually wrote the white paper, we found like a few like missing gaps. We thought like, oh, we were thinking this, we totally didn't think about that. And yeah, we went back and we are updating. And as we speak, like, we're still like making those updates and changes. And of course, like security is a big, of course, like priority for me and my project as our project as well. So not just security in terms of software security, right? We, of course, we got our code audited by QuantStamp. That is important. What is also important is the economic security or the model of the protocol. So that is something that we are internally doing right now, is doing an economic model of the protocol and trying to see, hey, like what are the scenarios where the protocol may break, do some like simulations, and then bring that back. And even like doing the testnet as well. I've not seen many DeFi protocols also do these, like what is called as like a guarded launch, right? Like they first, so we are going into a testnet, right? Like usually like layer one blockchains do this, right? They do testnet, they have like this, like some kind of like competition, like I think game of stakes in the Cosmos ecosystem, they did it. And even like Celo had something like that in the early days. So we want to bring that kind of model even to like our like DeFi protocol, to make sure that people can come and test it out. We give some like some like, we'll have a leaderboard, it'll be fun, like a game, like so you can come and like try to break it. You can also try to do
That's
other
sweet.
things.
Yeah. And are you building a community mostly on Twitter and Telegram, or how do you go about getting the word out?
Yeah, so for us, right, like we have a few values, right? Like the community comes first, and also for that one, what we are doing is we are building on Twitter, and we built a lot of like private communities all over the world. I'm like like a digital nomad. I travel everywhere. I'm excited to meet new people all over the world. So we actually have like a very like small community in Berlin. We built a small community in Mexico City. We built like a community
What does that
in
mean? When you built a community, does that mean you have what does that mean to build a community in Berlin?
Yeah, so what I did was like, okay, like when I was there, I met with like some potential like users. Of course, like people who are like have the shared same values and are interested in like the thing that we are building. So like physically, I would go and meet, maybe like do a few like meetups, do a few talks, host some events. I'm also a yoga teacher, so I don't
Nice,
get time to
dude.
teach yoga anymore. So what we do is like every Saturday I would be like, okay, let's go on a run and then do yoga in the park. So bring community together, do some things outside as well. So yeah, this is what it means, right, to build community. I mean, as in Mexico, it is more like I was in Tulum, we built a community there. There it was more about, hey, let's go get dinner, right? Like we just meet and hang out and like talk
It's
about
awesome.
what yeah.
That's super cool. I love that. I think it's awesome that you're able to do that, travel around the world and literally build communities, teaching yoga and meeting up with people. Um, Super cool. So, where are you now? How much did you raise through? You mentioned you raised institutional round. Is that done? And how much did
Yeah,
you
so we
raise?
raised like a seed round about like last August, September
Hmm.
timeframe. We raised seed round. We raised $2.35 million dollars, and then now we are actually planning to. We might do another round before we launch, so we don't know what that will look like just yet.
And will you keep that as a like private LLC company and raise that way, trading for equity, or how do you? Because you can do the token, but you're not doing that yet, which I think is smart. So I imagine you're raising on like a convertible note or safe round in the
Yeah.
meantime.
I think the model that people are using recently, which has gotten popular with like a lot of other projects, is you do a safe and a warrant. That is typically how people do. So the safe will give you access to equity, and the warrant will give you access to the tokens. And typically, what people do is they say, "Hey, like okay, like we're launching, we'll go into like a DAO or whatever." Then they just get rid of the equity part of it, and people just get the tokens. That's one way to do it. In our case, we have a few ideas, and some of it is like still like under the wraps, but yeah, soon to come.
What do you think about this? Do you think there's, I mean, by contrast, in the typical startup world, if you start a company, it's like Delaware C Corp. Maybe you have two founders, you have an employee stock option pool, 10% each founder, maybe each founder splits. So you have like 45% for each, and then 10% for employees. And then as you grow, you dilute the company, you give away 20% equity in exchange for each round of capital you go on. You seed ABCDE, you IPO, etc. And it's like there's the innovation in fundraising is discouraged because it's a fairly straightforward playbook that just works. So when you tell an investor, hey, we're innovating on the way we're raising money, it's like a red flag. They're like, I don't know if I want to be a part of this. You got like, my uncle is going to put in some money and we're going to do a rev share. And then like, we're going to trade secondary stock for, it's like all that shit is a no-go. But it seems more like in crypto, because it's new and because you have this additional mechanism with the token, there is a lot more innovation, or at least more accepted innovation. I mean, we just described a couple different ways of doing it with pre-sales, safe warrants. Do you think we'll get to a place where it's just like, this is how you do it in crypto, and there'll be very little need for innovation? Because it seems frustrating from the founders I talk to that it's unclear as to how you raise money based on where the company is, what the company does.
It's hard, man. It's hard. Like, it's hard to it's changed, right? Like, I think the industry has evolved, right? The way we were doing fundraising during the Bitcoin days was totally different, right? People would just create like these like forks and then add like a developer fee, right? Like how Zcash did, right? Like every block will have X percentage to the devs, right? That is one way. That is the early days, and then we went into the ICO way, where we said, okay, we'll write a white paper and go raise like hundreds of millions of dollars through that. And then now we have come into this, which is, I think, in a way quite unfortunate, right? I think, of course, the ICO days brings in a lot of people trying to scam and get money out of like retail investors, which is also not good. But it at least had like, if you were like good enough, if you had like good like investment skills or like good way of like finding out, access was still there. Like there was like so much freedom. Like I got into like so many good projects early on just because I was able to go read up like the white papers and see what the team was about, right? I got into like early days of like Polkadot and like, other like similar like projects. And now it's in a way unfortunate, right? Like we're moving a little bit into like the Silicon Valley model where we say, okay, people are raising seed round, pre-seed round. They're also doing Series A, and maybe then they go public. Sometimes people do seed round and then they go public with their tokens. But then it does not give like then your community early access. Like by the time you go, sometimes I think bad projects with bad tokenomics, they almost give up like 40% to these insiders, right? Insiders meaning the investors and the team, and the community just gets like 40-50% or less, even less than that, which I think in the long run, I think that's not a good project, right? That will fail, which is quite unfortunate. I would like to have better regulations. That way we can actually incentivize like the early adopters to come and like, also be part of this, but we can't do it because of the regulations. So this is the new model that people are going is, I think, it might get, I think it'll just keep evolving, man. I think at any point of time, there will be a certain model that most people are following, and that only you can find out only by like talking to other founders. Otherwise, it's really hard. Nobody publishes blog posts. There are few, not too many. If you want, I can send you some resources that I have that you can share with your audience as well on this.
Yeah,
given a lot
it's so
of
interesting. It's like there's a ton of innovation obviously happening on what the technology is, what it does, how people can use it. There's a decent amount of movement on the regulations, but given the fact that there's so many people from all over the world building so many different things with new technologies available, the methods of creating capital to fund these entities, protocols, or companies changes so quickly. There's not like one place you can go to see how all the different companies are structured, which it's kind of interesting idea. On this idea, I know a little bit about your interest in like fractional assets and ownership through Tesla. Do you think about this as something that could evolve into other types of assets, not just equities and stocks, but things like cars or houses? Or is that part of? To what degree have you thought about allowing people to trade those type of assets as well?
Yeah, I think being a synthetic asset protocol, literally any arbitrary asset that has a price feed, we can create assets out of. I joke sometimes, like, hey, if you get me a price feed of the temperature in your local town, we can create like somebody to like, trade that asset, right? We can literally create anything like that. But no, like to be honest, like we have given a thought, but in the beginning, right? One of the things, like biggest values we have is to bring access to wealth to people, right? Anywhere and to anyone. So what that means is then we want to start with like just simple tools, right? Like simple things that you go down the street, everyone, like you talk about stocks and commodities, people know it and people want to use these things. So that is, and then if you look at the other like projects that are doing this, there are not many projects, but if you want to do like some more esoteric like derivative projects, like oh, I want to do like perpetual swaps, or I want to do margin trading, I want to do options trading, right? There's so many DeFi protocols out there which get into like, okay, like they're not really helping bring like this like access to wealth to users. So our value is like, hey, we want to create these tools that anybody can use in the beginning, and then we can like innovate on top of that and like try to bring more esoteric projects. But one fun like product that we may create is like, hey, somebody to be able to trade like the floor price of an NFT, like, oh, this NFT is too expensive but I like it, so we can create like a product that like a synthetic asset product that tracks the price of a floor price of certain NFTs, right? So that is something that we have thought about. Like we can also do a lot of these like crypto native products, right? Like, so that is where our interest lies. I'm not personally interested too much in creating, hey, we want to do like real estate and stuff. Of course, like you can make money there, but it's just like not technically like not challenging for me or interesting for me to do that, right? Yeah. And again, like talking about values, right? We have a few values that we want to bring in and want to aim to like better what DeFi is right now. One is to use these DeFi protocols. It is so inaccessible to even like me, right? Like if people who, you have to have some kind of like technical knowledge. Even me, like when I go to some DeFi project protocols and I've not seen that in a while, I'm like, how does this work again? I need to like go and like do some research. So how can we make that easy for people to access it, and also easy to like, hey, like I have like this kind of like debt. How do I visually like see how much debt I have? What is the risk I'm taking? It's not very open and easy for on different protocols to see that. So we are spend a lot of time making sure that our designs are great. And the other one is a user experience around, hey, like if I want to like create like borrow some asset and create liquidity, sometimes people say like, okay, you go to Uniswap, create a LP token, bring that LP token back and do farming here. But why? Like, why should you go to Uniswap? It's all composable, right? Like, why not allow that on your own platform? So for us, like, we have this opinionated approach of like, hey, a user comes to our platform, they should be able to do all the actions on that platform, even though in the background, right? Somebody may be, the platform may use something like a AMM outside, but you can still create liquidity pools on our platform itself, and you can do farming on our platform. Whatever it is that you want to do, everything should happen on our platform, and we make that easy for users to use the platform.
And effectively make all the utilities like the AMM, the market makers, like Uniswap, just make those behind the scenes. Like no one would have to go to Uniswap. You could just do it on independent platforms, and the platforms themselves build into Uniswap. So the front end functionality is on those platforms.
Exactly. So what we will do is we'll release a protocol, right? And then we'll build a platform on top of the protocol, right? That will use the protocol to create these synthetic assets. But that platform can also allow people to like trade different synthetic assets. It can allow people to create liquidity pools on like different like AMMs, but it'll all happen in one dashboard from our protocol.
Got it. Yeah, the synthetic asset concept is super interesting. It's like if I put down collateral, the protocol creates this. Tell me if this is not the right way to describe it, but conceptually, this is how I understand it. That if I put down $100 in USDC, the protocol will create the synthetic asset of Tesla stock. As long as that Tesla stock is one of the options, I can't create anything. It has to be, select one of the 50 options that are available as synthetic assets. And then I hold this asset, which is a NFT effectively, right? It's something that represents, it tracks the token, it tracks the share price of Tesla. So as Tesla goes up, the value of this NFT goes up as represented on the protocol, and then I could always trade it back into the Kresko exchange and get my collateral back, and then trade in the synthetic asset. Am I describing this in the right way?
Yeah, it's correct. Yeah, I'll add on a few details to just like clarify certain things. One is it's not an NFT. Maybe next version it'll be an NFT, but right now it's just another like ERC20 token. So
Okay.
it's just like DAI or something, right? So you go into the protocol, you over collateralize it, you get the Tesla token, right? But then it's not doing anything when you get it. So there are two sides of the market. One side is the supply side. So basically, if you are to create this, then you are on the supply side. So you are making market. So once you create it, what you'll do is you'll then add like some USDC and put it on an AMM and create a pool, right? So that is on the supply side. So you are taking, so the user who will do this has to be a little more sophisticated because the price of Tesla starts going up, then you have to go back to your to your like vault and add like more collateral, right? It always has to be 150% or more.
Okay.
So you have to go back and keep putting collateral if the price of Tesla goes up. But then what is the reason for you to do that, right? Like there's no reason for you to do that. So that's why you go and make market. Like if your interest is to make markets, so then you go take that and put it on AMM, and then people can then trade against that, right? And then you can make that trading fee for doing that. And then if we do have incentive rewards, we're still like deciding whether there'll be incentive rewards or not. So you can also get those incentive rewards for having done that. So that is one side of the market. And the other side of the market is people can just go to an AMM and say, hey, I want to buy Tesla, right? Like they can say, okay, I want to buy synthetic Tesla. I can just give USDC and I can buy Tesla. They don't have to know this or collateralization, nothing, right? Same thing with DAI, right? Like now you can go to DAI and you say, hey, I have to take some profits. I made a lot of money in ETH. Let me go sell some of my ETH and buy DAI, and I'll hold on to my DAI, right? You didn't really go and create that DAI, but somebody else has created it. That is the other side of the market. Like there are some market makers who say, all right, I want to make some money doing this. So they can go and they say, okay, I will give ETH here and generate DAI. And for doing this, I'll get some interest for doing that. And then I'll take that and I'll sell that in the open market. So those are like two different sides of the market.
And on the market maker side, when I'm putting in USDC, when I put it, well, let me ask you it this way: when I'm making the market here, wouldn't I be effectively short selling Tesla? Like if I'm purchasing synthetic Tesla stock, then I'm getting more money. I'm getting more USDC out of the protocol than I put in, assuming Tesla stock went up. Say I put in 100 USDC, I have $100 worth of Tesla stock. Tesla stock doubles. Now I go back to the exchange. I want to take out $200 and make that trade. Somebody has to be on the other end of that trade, right? Somebody has to effectively be losing money, losing USDC. Is that the right way to think of it?
Yeah, so you are essentially taking a short positions, right? So when you actually create the Tesla and then go and sell it on an AMM, you have essentially taken a short position, right? You can literally just go and like sell it fully, then you're taking a short. But you can also take it and make market out of it on the exchange. So those are like, and then that's why it needs like somebody who has little more like financial like engineering knowledge to be able to, a lot of people like market makers, they hedge their bets, right? Like they can create like these things called as delta neutral strategies, where even the price of Tesla goes up or down, doesn't matter. You're always like neutral, your amount, and then any fee you make is like profit, basically.
I see.
So it requires a little bit of work to figure out like how to do your like delta neutral strategy. Yeah.
Interesting. Do you do that personally? Do you get into like advanced trading, crypto trading, market making?
No, I mean these days, I'm more like so. This is another like values we have is like long term investment strategies. Like we want to help people build growth. So we
Yeah.
want people to think long term, and that is personally how I invest.
Yeah.
And I used it is literally I look at my portfolio like for an hour. Uh, Before I used to look at least like 2 hours a week. Now I don't even have time. Like maybe an hour a month if I get to look at my portfolio. That is too much time. But no, I still go and like of course like play around with all these DeFi protocols to get insights into improving like what we're building, right? But otherwise, personally, like I don't do like any of these like margin trading or like doing
Yeah.
like any of like risky things. That is not me.
You have to be, I mean, you have to be all in when you do that. You can't be running a crypto company and doing that on the side.
Yeah.
Last question for you, and I'll let you run. I'm curious about this yoga. So how long, what has yoga done for you? Why do you think this is something, speaking for someone who does it every day and has done it for years, uh, did you learn in India? You have the Hindu hacker handle. How has yoga shaped you? Why are you an advocate for yoga?
Oh, good question. No, I think no, like I actually like growing up in India, like kids like, right? Like nobody does things what everyone is doing. No, like nobody, none of my people of my generation growing up in India, we didn't do yoga. Like, of course,
Really?
it was there. Everywhere.
Oh yeah.
We learned it when we were kids, but nobody got into it. I
Yeah.
actually came to New York. I was living in New York for like 7 years, and I had a back injury, and the doctor said, "Oh, you have to go and get surgery." I was like, why? This is the first thing you're telling me. Like, I went and started exploring different options. And then that's where I got into yoga. And then since then, I'm like, okay, like I got deep into it. Then I went back to India, met a lot of like teachers,
Yeah.
got super excited. And then started like teaching it as well, did a teacher training. And I continue to learn. Like, I think it helps me uh, keep my both like physical and mentally strong,
Yeah.
not freak out, keeps me sane. And now also, of course, I do like a lot of like meditation as well. I like to stay in like jungles. I'm right now in Costa Rica. Spent like 8 months traveling through the Amazons of like Peru and Ecuador. Met a lot of like shamans, and then yeah, I have a both like yoga and like meditation practice that that helps me a lot to stay focused, have like stamina to it's not easy to build a startup. Like I'm having like these kind of like high level like stress conversations that maybe when I was like an employee I would have like like small things like, hey, I want to ask raise, right? I would literally like stress about it for like weeks before I go to my boss and like want to ask for a raise, right? Those are like high pressure environment. And now I have to have these kind of conversations literally every day. Like I'm either hiring somebody or I'm like letting somebody go. I'm trying to raise money from investors, and literally I have to do these conversations like a few times single day. And I don't have the luxury of like few weeks to do one conversation because I have to have 50 conversations. Otherwise, my startup is like going to
Yeah.
be like dead in the water, right?
Yeah.
So yeah, no, all those things like the yoga and like meditation like helps you be ready for those kind of things.
A lot of shared experiences on my side too. So awesome to hear that.
Yeah.
Well, Hindu hacker, Hindu hacker on Twitter, Instagram. Any other personal places you want to shout out? I'm sure we'll have the links for Kresko in the show notes.
Yeah, I think
Yeah.
nothing beyond that. Like in closing, I would say, yeah, like go to our website, Kresko.fi. That is like KRESKO.fi. And Mike can put the links in the show notes as well. Yeah, and if you are a sophisticated DeFi users, we'd love to have you on our like alpha launch. Please do come and sign up on our waitlist. And yeah,
Yeah.
we'll see you
Sweet.
soon.
All right, brother. Great chatting with you.
Yeah,
See
likewise.
ya.
Thanks, Mike.